Hello, everyone. Thank you for joining us today as I get the slideshow ready for us. Thanks for joining. Today, we're going to be talking about things to do for year-end planning for businesses focused between now and December 31. There are certainly a lot of changes in the air after the election and where things might go, but we're going to concentrate on this year and the tax law as it stands right now. I'm really thrilled to have some exciting presenters for you today. I'm joined by my colleagues, Rick Woods, who's a partner out of Louisville and works with our national tax team. Catherine Baisley is in our Atlanta practice, and she concentrates in the real estate and pass-through entities area. Vivian Coors is with our tax credits incentives advisory team, concentrating in the R&D space, where I know there's a lot of questions coming on Section 174. And Tim Larson is a partner in our Austin practice. He works with our technology industry and brings a lot of experience from that direction. So I will go ahead and get started and turn this over to the team to kick us off.
Great. Thank you, Sarah. Again, my name is Rick Woods. I'm a partner in Louisville. Thanks for allowing me to present to you today. Just a brief trip through our agenda here, just to give you an idea of some of the things we'll be talking about in no certain order. We're going to talk a little bit about the latest with Section 174 R&D capitalization and what's going on with that. A lot of folks interested in what's going on with bonus depreciation as that phases down. So we'll talk about the rules there. We'll talk a bit about the pass-through entity tax or PTET elections in various states and the planning involved there. We'll talk a bit about clean energy tax credits and the benefits, tax benefits associated with those and the rules. The Secure Act and the impact on qualified retirement plans, a bit about buying and selling businesses and some important considerations if that's applicable to you. Choice of entity in the evolving state of tax law, and also some potential tax changes that may be coming down the pike. So large variety of things to talk about. I do feel the need to address sort of the elephant in the room. We did have an election recently, and there's a lot of buzz certainly related to tax law, because the Tax Cuts and Jobs Act, which was passed way back in 2017, I can't believe it's been that long ago. But when it was passed, some of the provisions in TCJA, like the reduction in corporate rates, the corporate rate was taken down. The top corporate rate went down from 35% to 21%. That was a permanent change. That's not going anywhere until Congress does something new, which they may do. There's been some talk about that from the Trump administration, potentially lowering corporate rates, but that'll require a future act of Congress. There were a number of provisions in the Tax Cuts and Jobs Act that are expiring. Some have already expired or sort of kicked in and causing tax increases for various taxpayers. And a number of the bigger ones will expire at the end of 2025. Kind of the big three that have already come up: R&D capitalization, which we're going to dig into a little bit later. Bonus depreciation phase out, which I previously mentioned, as well as some mechanics of how the 163J business interest limitation is calculated, basically going from an EBITDA to an EBIT calculation, 30% limitation. Those changes were already kind of built in and have already sort of taken place within the tax code through no action of Congress. In fact, Congress attempted to pass legislation, a tax relief bill last year. It did pass the House, just did not pass the Senate, was never enacted into law, that would have delayed a lot of those tax increases. That didn't happen because Congress basically couldn't get on the same page between the House and the Senate, so that did not happen. But essentially, you've got some significant tax increases coming, assuming Congress doesn't act. The expectation is that Congress will do something. Um, so many different possibilities there. We've got a new administration, but also a new Congress being seated in January. I've already been a part of some presentations, certainly listened to various presentations on what direction all that could go. We wanted to speak to the elephant in the room, but once again, as Sarah mentioned, we're going to focus today on things that clients can anticipate or do before the end of the year to lower or minimize their tax burden for 2024 and beyond based on existing tax law. But we did want to at least speak to the elephant in the room. One significant item affecting flow through businesses, the Section 199A pass-through deduction or 20% deduction. Essentially, it makes the top rate on qualified business income a max of 29.6%. Note that's a big one of those big tickets that's going to expire at the end of 2025, assuming Congress doesn't act. Impacts partnerships and S corporations with business income and their owners. Another one that I think has been focused on less just because it's not as perhaps as broadly applicable, but it's significant for taxpayers that chose to elect into this. And that's the Tax Cuts and Jobs Act created opportunity zones. And the idea there was clients with large capital gains, if they sold a business, sold a piece of real estate, sold property where they had a capital gain, if they chose within a 6-month window of time to invest their proceeds in an opportunity zone fund or made an investment in a certain area. And the idea was to help economically distressed areas. So it's very geographic in terms of what qualifies. But the idea was you could defer your gain and perhaps also even permanently eliminate some portion of the gain or future appreciation on the replacement property. Just note that that deferral is sort of coming to roost, if you will, or coming because ultimately the deferral was not permanent. It was to the end of 2026. So if you haven't had an event that requires earlier recognition, taxpayers who deferred a gain through an investment in an opportunity zone will have to pay the tax on their original gain in the fourth quarter of 2026, which is all of a sudden seems just around the corner. So we just want to note that and make sure it's on your radar if that's applicable to you. Note also that we had some temporary enhancement to the deduction for meals. Meals that were at restaurants with employees, clients, etc., were temporarily for 2021 and 2022 100% deductible. That went back to 50% for the 2023 tax year. So just make a note of that. Entertainment expenses under TCJA were made 100% non-deductible, no changes there. For businesses that have international operations, the TCJA put into effect GILTI and FDII. GILTI is Global Intangible Low Taxed Income. This is for U.S. Generally for U.S. investors in controlled foreign corporations that have foreign income that's not already taxed under Subpart F. TCJA put into place a current tax on that income at a reduced rate. Just know that that effective tax rate through the mechanics of the deduction that's allowed is actually going up. The effective tax rate on GILTI income will go up from 10.5% to 13.125% beginning in 2026. And then the FDII or foreign derived intangible income, think, export income of a U.S. domestic entity. They get a deduction for certain intangible US-based intangibles. This is a deduction on your US return. Just note that the effective rate on FDII, or foreign derived intangible income, will also increase from 13.125% to 16.4% beginning in 26. And that's assuming Congress doesn't do anything to delay that. So just note some changes coming down the pike there. I want to hand it off to one of my colleagues who's going to talk about some other items that are new for 2024.
Hi, everybody. I'm Catherine Baisley, and as Sarah mentioned, I focus in the real estate industry and pass-through entities. So we'll touch on a little bit of what's new about with pass-through entities in 2024. But also, Sarah said the words exciting and for CPAs in the same sentence. So I want to make sure we kind of level set on what's happening here, because pretty sure tax isn't terribly exciting for everyone. But the IRS is shifting their attention to pass-through entities. We have seen that with the change in the audit rules around partnerships. You know, we've switched from TEFRA to the BBA. For those of you that are practitioners out there, we're seeing more audits of smaller entities. And the IRS has actually reorganized the Chief Counsel Office and field examiners to focus on pass-through entities. That includes trusts, partnerships, and S corporations. From what I have experienced, the agents that are responding to those directives aren't very well versed in those areas. So there is a lot of education that is needed by the CPAs that are handling those audits and those questions. So just something that everybody should be aware of, whether you are the preparer, whether you're a member of a partnership, there is increased scrutiny around that. Kind of building on that, every year we see some other type of guidance or request from the IRS that is requesting more detailed information around partners and their basis, or what comprises, you know, contributions or distributions. And we're seeing that again this year with Form 7217. And that is a form that now requires the taxpayer to give much more detailed information about any property distribution and the basis of the related property. So it's a new form. It's not a long form, but it will be incredibly important to have that information correctly reported. And kind of building on the whole partnership and more information theory and changes with the IRS, there will be a guidance package on basis shifting transactions between partners and related parties coming out. There is a $5 million threshold on that, but that is something that we will need to focus on. Here's a slide with a little bit more information, and this slide deck will be going out in about a week or so, so you don't need to worry about writing all of this down. But notice 2024-54 came out, and it includes 2 sets of future proposed regs, and that addresses these basis shifting transactions that I just mentioned. And they are looking at what they are calling transactions of interest, and it will require disclosures from participants and material advisors. They are concerned about the economic substance doctrine that is so familiar to those of us in the partnership world, and keeping an eye on the basis and basis shifting, especially through distributions to related parties. Something that will be very, very closely watched. And state law limited partners and the SECA tax. SECA tax is FICA for clergy and self-employed individuals. You know, self-employed individuals now have to pay the employer and the employee side of things. Well, state law and the IRS differ on what is a limited partner. And historically, preparers and practitioners have taken the position that a limited partner is not subject to SECA tax. If they're paid guaranteed payments, yes, but in the operating income of the business that is flown through to them that is not a guaranteed payment, that historically has not been subject to SECA tax. Well, the IRS is arguing it and saying they may be considered a limited partner, in theory, because that's the box that they've checked, but they are acting more as a non-passive partner. So the IRS is kind of imposing hey, just because you're a limited partner doesn't mean you're passive. And they're kind of intertwining the two, which are two totally different things. So there are two cases that everybody will be curious to see the outcome to. It's the Sorban Capital's Partners case and the Cirrus Solutions case, which are both fighting this very issue, where they have limited partners that received ordinary income allocated via K-1, and the IRS is saying that should be subject to seek a tax on top of the guaranteed payments that they've received. So it will be very interesting to see how that comes out. That will unwind a lot of what we've done. And the IRS is also working on some regulations that will help to determine and define limited partner status. So we'll see what happens there. There's definitely a lot coming. And now I will be kicking things off to Tim. Or no, Rick. I'm sorry, Rick. Sorry.
Okay, thank you, Kat.
Probably gave Tim a heart attack.
I want to briefly talk about four Supreme Court cases that have an impact in the federal tax arena. The first two, Loper Bright and Corner Post, were generally both taxpayer friendly or favorable. What these were about, the first one, Loper Bright, overruled Chevron deference. Now, what is that about? The idea is historically, for the last 40 years, based on a Chevron case, ultimately, the courts that decided, not just tax cases, but any case between a government agency and private citizens and or businesses gave a strong preference to a federal agency's interpretation of statutes that are passed by Congress. That could include a tax statute or Internal Revenue Code section. What the significance of this case is essentially that the court is now more free to apply its own reasoning and analysis on whether the government agency is lining up with the statute or whether the taxpayer is more aligned with the statute. In other words, not necessarily just following the IRS's interpretation of tax law. So that's generally favorable, that the court will be more independent in its analysis, and that could help taxpayers that have litigation going with the IRS. The other case, the Corner Post case, is also taxpayer friendly. The idea is historically, if think of it this way, if the IRS had already been challenged in the context of other taxpayers and a 6-year statute of limitations has since passed, essentially that's precedent, right? But the Corner Post case basically said it doesn't matter how old or established the provision is, if it's impacting a citizen or individual or taxpayer personally for the first time, the statute starts running the first year it impacts, in this case, thinking of tax law, the taxpayer. So again, another taxpayer friendly ruling that may have consequences favorable for taxpayers in the tax litigation front. So that's good news. Other cases that also were very significant, one that tax practitioners were watching was the Moore case. And this case relates to a TCJA tax provision that essentially, think of like owners of foreign businesses that kept the earnings reinvested in foreign jurisdictions and hadn't repatriated that income to the U.S. could generally, unless Subpart F applied, could defer that income for U.S. tax purposes. TCJA, with certain reduced tax rates, basically caused mandatory repatriation, even if the money stayed invested in the foreign country. U.S. taxpayers who own that business were still going to have to pay tax on the unrepatriated earnings because they were deemed to be repatriated. This was challenged in the Moore case, whether Congress and the IRS had the authority to do that, given the fact that the taxpayer in many cases, what Moore argued was that, they never had a realization event. They had made an investment, but no dividends or earnings had been repatriated to Moore. Therefore, how could Moore be expected to pay the tax? That was considered to be unfair in a sense. So the challenge there was whether Congress had the authority to enact that. And this sort of had, people were watching this closely because of a lot of discussion on wealth taxes and some other taxes that would tax unrealized income. The result of this case, the Supreme Court ruling, the main thing to take away, it's narrow in that it doesn't address anything outside of flow-through businesses. But what was pointed out by the Supreme Court is, essentially this is already happening with respect to S corporations and partnerships today, and that's established tax law that, earnings flow through, even though they may not be distributed by the S corp or partnership, the individual can still be taxed on that. And this is similar to that, this mandatory repatriation tax. So the Supreme Court said that's okay. But again, narrowly focused, doesn't have application outside of pass-through entities, but a significant case that we were all watching. And then finally, Connolly versus the U.S. This has implications, buy-sell agreements, corporations that will often have life insurance policies on the owner of the business. And the proceeds of that life insurance policy, when the business owner dies, it's used by essentially the entity to buy out that deceased shareholder stock. The question is for estate tax purposes or gift tax purposes, how do you value the stock? So this doesn't really make any changes to the tax code or the application of the tax code, except it's all about valuation principles and how you value corporate stock, where the corporation could receive or is receiving life insurance proceeds. And essentially the Supreme Court said that the life insurance proceeds should be taken into account in determining the value of corporate stock. So impact on buy-sell agreements and in the estate and gift arena there. All right, I want to say a word. We certainly had some very significant storms this year. Hurricane Helene, Hurricane Milton. Our sympathies and condolences go out to anyone who was impacted by those storms. And we just want to bring up in these cases, what you may know is the IRS will issue some relief for taxpayers that are impacted by those disasters. And the IRS did so for both hurricanes as well as other storm events and other disasters that took place in 2024 around the nation. Just note that if, essentially what the IRS allows is an extended filing deadline and also extended time to pay any tax that may be due, whether it's an estimated tax payment, whether it's a tax due with the return that wasn't due before the disaster. They will provide relief from penalties for late filing or late payment that can be very helpful if you're impacted. So these are, again, targeted to certain geographic areas designated by FEMA and the IRS. We want to also just note that there are special casualty loss elections that can apply if you're impacted in a disaster zone or area. There's an election that can be made to take a casualty loss, not necessarily in the year it was incurred, but the prior year, which can be helpful if you can, the deduction or the loss might be worth more in that year, or from a timing perspective, it might be better to take that loss in a prior year. Just note that that election is available if you're impacted by federal disaster relief. Also, the opportunity to do an involuntary conversion, where essentially you had property that was damaged or destroyed, and essentially you have 2 years to replace that with similar property. There's relief that can be, there's special rules that may apply. So you want to discuss the involuntary conversion rollover opportunity with your tax advisor, because there are some enhanced relief provisions if you're impacted by a federal disaster area.
All right, we're going to skip ahead in the interest of time and go on to what's not new for 24. And that brings up our first polling question. For those of you that have been looking for it, our first polling question is, how much asset base can be deducted under bonus depreciation in 2024? Is that 100%, 80%, 60%, or not sure on that one? So we'll just give you a bit of time to address those questions, this question, and get your answers in on there. And hopefully everybody can see it. If you have any issues with the polling question, then you can please reach out in the Q&A and let our production team know if you're having any issues responding to this first polling question. So how much bonus depreciation is available here in 2024? So we'll just give you another little bit of time to go on this one. So we can get on to then talking about 174. All right. That's great. I see a lot of you say 100%, 80%, 60%, and not sure. So let's see exactly what the answer is on the next screen. The answer is 60% for 2024. So any assets placed in service in 2024 are only eligible for 60% bonus depreciation. The other 40% relies on the regular depreciation rules. So with that, let's go on and turn it over to Vivian to talk about where we are with Section 174, because I know that's an important issue to many of our folks.
Hot topic. Thank you, Sarah. And this is how I stay popular. Everybody wants to know about 174 and R&D. So as of right now, to plan for the 2024 tax year, it is unfortunately still in place that taxpayers are required to capitalize and amortize their research and experimentation costs for domestic costs over 5 years and for foreign costs over 15 years. So that unfortunately has not changed. Although earlier in the year, there were bipartisanship bills that passed. The House, unfortunately, no news as of yet. So the best plan forward is to plan and look at it, analyze it accordingly, and see what the cash tax impact for you guys would be. And obviously later on, as we go through the slides, we'll have other ways in which we can explore and talk about how best to minimize your 174 impact and look at other ways for tax savings, either through maybe a federal or a state tax credit or other accelerated deductions. So Notice 2023-63 came out September of 2023. September of 2024. Oh, no, 2023. It's been a year now. And this provides a lot of guidance around what is considered R&D, what is capitalizable, what is not considered 174 and therefore can be expensed. So there's a lot of guidance in here that's important and can shed light as to your particular situation. Again, though, I do want to highlight, to the extent that you are performing research under contract, depending on your facts and circumstances and the contractual agreements, it would either be something that you would need to capitalize, even if you are getting paid to do the R&D. So that's definitely an area that folks need to explore extra carefully and look at your contracts. And to the extent that you're negotiating contracts right now, either to pay somebody to do R&D on your behalf or your customers are paying you to do R&D, that's definitely something to look into according to Notice 2023-63 and see how it applies to you. And the good news is there's supposedly some proposed regulations that are coming out for 174 in early 2025. That's to be determined, and we'll see what actually comes out of it. So on section 174, I do want to highlight that if you have not properly adopted section 174 capitalization, it is an accounting method change, an automatic accounting method change. So that there are Form 3115 and instances where that form is needed. I would say most cases, if you previously did not capitalize, and this is your first tax year that you're looking to capitalize, in most instances, you would need a Form 3115 to properly elect a method change. There are instances, however, where you might not need a Form 3115. So to the extent that this is truly your first year where you do have specified research and experimentation versus previously you did not, that might be an instance where truly you do not need a 3115. Or other cases would be if you are a new entity, this is your first tax return, or you don't have a established impermissible method. Those are instances where you might not need a Form 3115. And I believe, Kat, I pass it on to you.
Actually, it's over to me.
Oh.
And Kat, I can neither confirm nor deny whether I had a slight heart attack when you tried to call an audible. So,
Sorry.
okay. So I'm going to talk about pass-through entity tax elections. And while PTET is the acronym, and we have a lot of acronyms in here, is not new for 2024. I wish I could say that it became easier for 2024, but because many states are still adopting PTET regimes, or in some cases tweaking them or clarifying the operation of the existing regimes, we still see it as an area of complexity. Naturally, some states are much more challenging than others. We have our usual suspects out there, but that said, states generally take one of two approaches with PTET legislation. They either allow the owners of the pass-through entity an income tax credit for their share of the PTE paid by the entity, or they reduce the owner's state taxable income by the amount reported and taxed on the pass-through entity's return. In my view, the complexity of any PTET regime often lies in making the election timely and making it correctly. It would have been far too easy if all the states had kind of gotten together and colluded to adopt the same or similar mechanics to make elections, but of course they didn't. So instead, you'll find in some states the election is made on a timely filed, even extended return. It might be made on a designated website, possibly by a certain date, possibly with a certain minimum amount due, that if you don't hit that minimum amount, it can later be nullified. In some states, or in some cases, you have to make it separately for the city, like New York City, than the state. So there is a lot of complexity within the PTET. So it's critical to basically board that train early so you don't miss the election. If you have refunds and overpayments, these also need to be carefully considered and determine whether it can or cannot be applied to future PTET payments or vice versa. Or sometimes there's even another player in the mix, the non-resident withholding, where you also have PTET payments. And so some states don't allow you to basically cross credit. So it again, in my opinion, is still a very complicated area. So, and finally, it goes without saying, just make sure that any PTE payments that need to be made are made by year end. Absolutely critical. Okay, so let's move on to some credits. We've got lots of credit speak and a lot of technical terms, but the IRA, the Inflation Reduction Act of 2022, included a range of energy tax credits to encourage transitioning to clean energy production, advanced manufacturing, the adoption of clean vehicles. We also call those CVs, reduce greenhouse gas emissions, and so on and so forth. So I will say right up front that the energy tax credit regime is complicated with detailed definitions, technical requirements, specific construction start date, placed in service date cutoffs, phase in, phase out dates. You name it, there is a lot here. Tax exempt financing rules and a ton of other nuances. Various technologies may be eligible for multiple credits, but there are rules in place to prevent double application of tax credits. So I'm just going to go through a few of the credits because they're really, we have a brochure that I think is 11 pages long that lists all the various credits. But I just want to level set for those that are not as tax savvy on our listeners today. Why do we like credits? A tax credit is a dollar for dollar reduction of tax owed, whereas a tax deduction reduces the amount of your income subject to federal income tax. Okay, most of us probably knew that. Could have been a polling question maybe, but it's not. But that's why we really like credit. So on we go. So first, there is the credit for qualified commercial CVs. I'm not going to get into the code sections, but basically businesses can claim a tax credit for qualified commercial CVs, again, clean vehicles, placed in service after 2022 and before 2033. Sounds like a long ways away, but it'll be here quickly. The credit equals the lesser of either 15% of the vehicle's basis or the incremental cost of the vehicle, which is defined as how much its purchase price exceeds the price of a comparable vehicle. The maximum credit with a gross vehicle rating of less than 14,000 pounds, this, that, and the other, $7,500. And for all other vehicles is 40,000. So less than 14,000, 7,500, all others 40,000. This eligible tax credit reduces the cost basis of the vehicle allowable for federal tax depreciation purposes. So sometimes this is where some nuances come into play. You get credit, but you have to take the basis reduction. So moving on to the next one, the alternative fuel vehicle refueling property. There's not a good acronym for that one. For this one, I'm just going to touch on it. For depreciable equipment, the tax credit is basically 6% of the costs incurred unless it meets the qualifying wage and apprenticeship requirements, which you're going to hear that phrase a couple of times come out of my mouth today. But businesses can claim a 30% credit, 5x, that 6% for projects meeting these prevailing wage and apprenticeship requirements, which basically just means people have to have pretty good pay and get pretty good training. So you're not doing this on the cheap. It's a little more technical than that, but that's kind of the gist of it. So this particular credit limited to $100,000 per property that is located in a low income area or a rural area. So, okay, let's move on to a not so new one, the Section 48 investment tax credit. This one is designed to encourage businesses to invest in energy related assets. And basically this base credit is 6% of the basis of the qualified energy property. But again, it can go up to 5 times that, 30%, if the project meets the prevailing wage and apprenticeship requirements. There's another kicker that if it meets certain domestic content requirements, i.e. utilizing stuff within the US, stuff is not a technical term, you can also increase the credit another 10%. The Section 45 production tax credit. This provides a base tax credit of 30 cents per kilowatt hour for electricity produced. Okay, that's kind of above my pay grade, how all that works, but it's very important because this credit is applicable to wind, closed and open loop biomass, geothermal, solar, municipal solid waste, a lot of what I would say are pretty cool things. This credit can be a huge incentive for businesses to transition to renewable energy sources. That's why this one is so popular. This credit applies to a 10-year period of energy produced by the taxpayer from qualified resources. Okay, so the ITC, investment tax credit, and the production tax credit, the PTC, both existed prior to the IRA. So why so popular now? Well, the IRA basically did something very relevant. It gave taxpayers the ability to monetize these tax credits via transferability. It basically allowed eligible taxpayers to transfer a portion or all of the tax credit to an unrelated transferee in exchange for cash. So prior to that, people had to rely on very complicated tax equity type or sales leaseback transactions in order to achieve these benefits. So guess what? In 2024, there were several marketplaces launched to facilitate these transactions. So if we look back to the first quarter of this year, 2024, a lot of activity. Taxpayers started trying to monetize and things started taking off. So the seller of the credit receives cash from the sale, and that's excluded from their income in that exchange, while the buyer is basically buying credits at a discount. So it's really a win-win if you can meet all these kind of other technical specifications that have to be met. So there's a huge opportunity. So before I move on to the next slide, who should be exploring the PTC, the ITC? Well, basically any C corporation with a federal tax liability, or any other entity with passive income and a federal tax liability. The passive income is key. Anyone investing in clean tech and clean energy assets should consider it. Anyone building or remodeling commercial or residential property. So it's really a very broad spectrum. Okay, so let's move on to our next polling question.
That is great. And so our polling question is, do you think C corporations are interested in purchasing clean energy tax credits in one of these energy credit marketplaces? Do you think a C corporation with a tax liability is going to look out there to buy some of these federal tax credits from another company that has gone in and invested in those? That is great. And I do like that stuff that you identified, that stuff is not a technical term when it comes to the clean energy production.
It's one of many in my portfolio.
It's a very useful term in the tax world. Covers a lot of ground. All right, so I think we're getting close to the end on this. We'll give you just another few seconds or so, another 10 or 15 seconds to go ahead and answer that one. Great. And a lot of you said yes, about 68%. And some of you said no or not sure. C corporations are large taxpayers, have been very active looking at the marketplace and scooping up credits that are available to sell and hugely beneficial to those that are selling. So let's talk about some other opportunities for tax savings and deferral. Vivian, I think you're up next.
Thank you, Sarah. So as we kind of mentioned earlier, right, there are different ways in which you can help tax plan better and figure out what you as a company need to be doing. Here are listed a few tax credits that have been around for quite a while. In addition to kind of what Tim had mentioned earlier, in particular, I do want to highlight that for the R&D tax credit, there has been quite significant proposed changes to the Form 6765, which is the form that you will be claiming your credits on. In particular, previously, the 6765 is just asking for kind of quantitative analysis numbers. Now it's asking for a lot of the business components of your project information. That for now is optional for your 2024 tax filing year, but it becomes mandatory for most taxpayers in 2025, unless you have, low credits, low qualifying research expenses. But otherwise, to the extent that your company's thinking of moving, expanding, hiring new people, job retention, those are all areas in which we should be exploring different tax credits, benefits, negotiations potentially with your state and local tax authorities to either save on maybe property tax abatements, maybe it would be your state credits and opportunities, which we will go into in a little bit more detail. And I know we only have 15 minutes left, so Sarah, I won't dig too much into the different tax credits, but here are listed just a few examples.
Okay, I think it's back over to me. So let's talk about some capital asset expenditures, some that might give rise to a credit, some that may not. They're just deductions. So bonus depreciation, we've touched on that. Had a polling question on that. 60% in 2024, 40% for 2025. What happens after that to be determined? Section 179 expensing. This one is pretty significant. I mean, essentially it allows businesses to deduct the full amount, the full purchase price of qualifying equipment and or software purchased or financed during the year. So that means if you buy or lease a piece of qualifying equipment, you can deduct the full amount from your gross income. The 2024 amount, or the maximum 179 expense deduction, is 1,220,000. 1,220,000. Many years ago, this section 179 was often referred to as the SUV tax loophole, or even the Hummer deduction. Not so much anymore, because the IRS was able to kind of whittle that back, so people weren't buying these nice equipment for their businesses and able to write off the full amount. Yeah, sad face, I know. Okay, so what else do we have in here? We have section 179D, energy efficient commercial buildings deduction. So this, again, if you in your business, or you're aware of somebody is basically renovating, commercial building, section 179 is available for that. And basically for those that work on the construction of these buildings, including architects, engineers, and other designers. And to qualify for this tax deduction, the property must reduce energy consumption by 25%. How is that measured? There's rules for that. The tax credit is basically up to $5 per square foot of the commercial building. Does that sound like a lot? It very well could be, depending on the amount of square feet. The key thing is section 179D is a permanent tax deduction, permanent. So you don't ever have to give it back. Still not a credit, but a tax deduction. There is a bonus deduction to this that is 5 times this base amount if, yes, wait for it, the project meets the prevailing wage and apprenticeship requirements. We hear that again. How about a credit for energy efficient homes? Okay, we have one for that too. This credit goes to eligible contractors for newly built or substantially renovated energy efficient homes. $5,000 maximum for this credit, available for 2032. So all I would say is, people still, if you are looking at a major purchase and you have the choice of this year versus next year, I would really consider this year if it makes sense. Okay, let's move on to deferring gains. So now we're shifting our way from some attention from deductions to gains. The opportunity zone, section 1031, like-kind exchanges. These are all opportunities, no pun intended, that are still out there. The 2017 Tax Cuts and Job Act created the opportunity zone. It is still there. We are coming up to 2026 when some of these gains might have to be recognized, but there is still an opportunity to permanently eliminate or defer any capital gain on the appreciation of properties held within the fund by the fund for 10 years. So I would still encourage people to take a look at that. Section 1031, like-kind exchanges. There's about 6-7 weeks left in the year. Maybe you could pull one off for 2024, but there are still opportunities to defer gain on like-kind exchanges of real property. Installment sales. Do you have the ability to, you might be selling something. Could you push some of that gain into the next years by deferring some of the compensation or sales proceeds when it's received? Maybe rates are going to go down. Maybe they're not, but that is something that is still in the arsenal of pushing off gain from this year to next year. Financially distressed projects. That's another area. If you have something of that sort, okay, this is maybe not a gain deferral per se, but we just recently worked with the client on looking at the disposal or the disposition of a partnership interest, and we were able to work through an abandonment. An abandonment of a partnership interest, not so easy to do, but it gives ordinary loss treatment instead of capital loss treatment. Very powerful. So let's move on to the next slide, please. Deducting pass-through losses. Okay, so for me, I view this one as either, I'm going to use a track analogy, maybe the 440 relay, or even a sprint with 4 hurdles on it. This, obtaining a business loss or a pass-through entity can be one of the most difficult things to obtain. And basically there are 4 hurdles, these 4 hurdles here, and they are applied linearly in this order that you see: stock and debt basis limitation, and on down the line. And this is something that, you know, I say the 440-meter relay because everybody has to receive that baton, hand that baton off without dropping it to get around the race to get this law. So for those who like code sections, the stock and debt basis limitation, we're looking at section 704D. The at-risk limitation is under 465. The passive activity, 469, and 461L is the excess loss limitation. And basically they each have their own forms or schedules that go along with that. So it is very sometimes difficult and often overlooked to obtain that loss. For the longest time, it was just the first 3. The 3 amigos. And then in 2017 came along the excess business loss limitation. That loss limitation currently for 2024 has an income threshold for married filing joint and people of 610,000. Everybody else is half that at 305,000. So if you're coming up short on basis, what can you do if you have an interest in say a partnership? Maybe you loan money to the partnership, or you contribute capital to give yourself some more basis such that you are able to deduct currently a loss. If you do happen to make a loan, you really have to be certain that it's bona fide debt. You do all the things to make the duck walk like a duck, sound like a duck, and look like a duck and be debt, because the IRS is very sensitive to that. So those are things that in order to get that pass-through loss, I would definitely keep an eye on these hurdles. Okay, moving through to the next
We're
slide.
gonna skip
Yep.
over to our third polling question.
All
Sorry, Rick, I'm gonna cut you out there and in the interest of time and move along to our third polling question. So what is the limit for expensing business meals in 2024? I think you heard Rick mention it closer to the top of the presentation, but we just wanted to remind you where this is. So what do you think the limit is for expensing business meals in 2024? And then on this one, so business meals expensing, and then yeah, Kat, we'll move on to your next, which is really sort of a scrub the balance sheet, look for opportunities, some basic blocking and tackling when it comes to year-end planning opportunities. All right, we'll just give you another few seconds to answer this one on what is the business expensing limit, 100%, 50%, $60 per day, or you're just not quite sure. I like the McDonald's French fries that came up. That's great. Yeah, 80% of you got it right. 50% is the correct answer for this one. So well done on that. All right, let's move on, and we'll talk about again some basic blocking and tackling when it comes to the year-end planning.
Hello again, everybody. We are running short on time, so this is going to be tax speed round. Okay, deducting costs of tangible property. One easy way to do it, de minimis expensing election. If you have applicable financial statements, think audited financial statements or financial statements that you submit to a governmental agency or the SEC, you have a $5,000 limit that you can just automatically expense. That is, per item. It is, go for it. If you do not have applicable financial statements, your limit is $2,500. Now, it is important that you have to have a written plan in place if you have applicable financial statements. Deduct these items for book. For tax purposes, we'll make the election in the tax return, and we will follow that same election in the tax return. Think about, and kind of next subject, think about faster recovery for your tangible property. Take some time now to review your fixed asset schedules. Look for opportunities where you can catch up on missed depreciation. Review your dates that assets were placed in service for accuracy. Think about a cost segregation study. That phenomenal way to accelerate depreciation. Identify deductible repairs. Think about the tangible property regs and, whether it was a betterment or an improvement, think about the Be creative and communicative with your CPA. If you put in a new HVAC, is it that you have 10 units sitting on the rooftop of, a strip mall and you only replaced 1 or 2 or 3, and those can be expense, or did you replace all 10? Let's have conversations, be creative, obviously within the rules, but look for opportunities to deduct some of these costs. And of course, non-incidental materials. Inventory reserves and subnormal goods. This is one of the questions that always comes up at tax time, or, when we're filing the returns months later. Yeah, but I have some inventory that, it's not quite right. I need to write off my inventory. Take the time to do that now. Identify your subnormal goods. Follow these steps. The reason you can't sell it at regular prices, offer it for sale, document, or consider a change to LIFO, last in, first out, rather than first in, first out, FIFO. I know I'm speeding through this. Reserves and accrued expenses. This is another thing. I love, you guys are the best with all of these reactions. Look for opportunities to clean up your balance sheet. Do you have worthless or uncollectible accounts? Let's handle it. Accelerate payments before year end. Look at your bonus plan and your accrual accounts to see what can be done. Consider a bonus pool. Look at your deferred comp plans and the vesting around those. There is a lot that can be done, but you have to take the time to look at it now. Okay, small business exception and exemptions. This is a review of annual gross receipts for the last 3 years of not more than 30 million for 2024. And you're not a tax shelter. Qualifying as a small business allows you to be exempt from the business interest expense rules under 163J, the UNICAP rules under 263A, accounting for inventory and long-term contracts. This could be extraordinarily helpful. Make sure you are keeping an eye on this. I think I have one more before I turn it back over. Okay, action steps. Screenshot this. Pay attention to this when you get the slide deck. Consider an installment sale. Huge opportunity. Look at your charitable deductions. Sell depressed stocks to harvest losses. Tim talked about this. Abandon your worthless investments and assets. Adopt a 12-month rule. It seems like common knowledge, but we need to say it. Decelerate revenue towards year end. Decelerate revenue, accelerate payment of expenses, big things that, can make a big difference. We have 6 weeks to do this now. Delay your cancellation of debt transactions until 2025, limit your non-deductible expenses, and adopt a defined benefit plan. Let's see, do I have anything? Okay, is this me? Oops. Sorry, I just lost the screen.
No, I just skipped over to one of our wrap-up slides before we hit our last polling question. So why do we go to all this trouble? Kat?
Yeah, so we go to all of this trouble because we want to make sure you're informed, take action now to try and pay less in taxes. There's a lot that can't be done once year end passes. Make a plan for 2024 extensions and first quarter estimates. Pay attention to what we've talked about and reach out to us. How can we help you? For those of you that already have CB advisors, reach out to them if they haven't gotten to you first, and actively talk about these things. So much can be done, but we have to be on the front end of doing it and not reactive. Sarah, okay, woo!
Good job. All right. Thank you. We will pull up our last polling question here. And that is, of course, a self-serving one. Have you started year-end planning conversations for your business, whether that is internal or with your CB tax advisor or other tax advisor? We certainly encourage this to happen. I want to say thank you to our 4 presenters here today, Catherine Baisley, Rick Woods, Tim Larson, and Vivian Kors. One other thing, again, there will be a short survey after this presentation. I ask for your input there so that we can make this better. We will have a copy of the slides available to you, and a recording of this presentation will be available as soon as our marketing team cleans us up and gets us ready for prime time and moves on. And just as a plug for tomorrow, same time, same bat channel, we're having a session on year-end planning for individuals and families and thinking about estates and trusts. So if you are interested in that, we would love to have you join us. Again, you could sign up on cbh.com, our website, to attend that one. So have you started your year-end planning conversations? We certainly hope so. And thank you very much for attending our webinar today. And that is all. I think we finished right on time.